In the last video we looked at market cap. If you haven't checked out that video, I'd highly recommend it before moving on to this one, as this builds on what we learned in the last video. In this video we're going to be looking at book value, specifically how to calculate it, what it is, and the significance of it when you're investing. As always, this is not financial advice, these are purely educational videos. Always please do your own research before taking a position. What is book value? All it is your assets, your total assets, minus your total liabilities to get your net position, and that's your equity position. Say you're interested in a company like Lloyds, you could go onto their annual report. In there you could go to their financials, look at their balance sheet, and from the balance sheet you'll be able to see your total assets and you'll be able to see your total liabilities. If you take the assets and minus the liabilities, you'll be left with equity. Now, if you think about it, if a company was to fully dilute, essentially you're almost saying that a company will be worth that equity figure if you were to fully dilute it. Now this is really important, because if you were to look at that and you were to look at the price that the market is valuing the company at, that difference there needs to be accounted for by other factors such as potential earnings in the future, or say some intangibles as well, which might not be in the balance sheet. We can go through this in more detail with some examples. So very quickly, here's an example of how to calculate book value. So say we want to find the book value of Lloyds. First we'll start by looking for the annual report. So here I've just typed Lloyds annual report into Google, and I'm going to click on the top one here. Perfect. I'm going to go down to the annual report. There we go, annual report and accounts. And from here I'm going to scroll down to where their finances are. Financials are usually sort of 2/3 of the way down. Balance sheet here. So I have total assets here for Lloyds in 2020 of 871 billion. And on the other side I have liabilities of 821 billion pounds. So my equity position is one minus the other. So if I just get my calculator open here and I look at the total assets that Lloyds has, which is this number here, and I minus off my total liabilities, which is that number there, I get what should be the equity position, which if I just go down here, total equity is that number there. So that's correct. So that's the equity. That is what the book value of this company is at the moment in time. So if we were to sell everything and we were to get the book value, we'd have this value here. And if we were to pay everything off at its book value, we'd get rid of this bit here, and we'd end up with our equity position, which is this number. This number here, total equity. So that's that there. So that's how you work out your book value. This is quite handy when you compare it to the market cap. So if I compare this equity figure that I have here to the market cap for Lloyds, which is this number here, I can get my price to book value. So this is my price. Copy. This is my price to book value of 49.4, and we have a price to book value of 0.623. What that essentially means is for every £1 that this company has in net assets, the market is valuing it at 62 pence, roughly. Now that is significant, and it's quite significant for a bank because it shows that their assets are actually at a discount when compared to what the market is valuing it at now. So if you look at this by itself, it might not seem that interesting, but when you start to compare other companies, say you were to look at Barclays, NatWest and HSBC, maybe Standard Chartered and Lloyds together, then you start to get a picture of which company might be overvalued or undervalued compared to other companies in the marketplace. And there are many reasons why there could be this difference. It could be because of what it actually comprises of. So here you've got a largish cash balance of 73 billion, which is about 10% of its total assets in cash, which is interesting. So there are many reasons for the discrepancy here. It could be because the company just isn't as profitable as its peers, it could be because the market is not optimistic at the future potential of the company. Maybe shareholders don't like the way that the company's being run, and as a result they've sold their shares, and that's why we've got a lower share price than the book value. But I always use book value just to gauge roughly what the market thinks of a company, and roughly how expensive or how cheap it is. Some people will say it's a flawed way to look at a company, but I definitely think it's a good starting point. What I've done, I've gone into the annual reports of all these different banks here: Barclays, Lloyds, NatWest, Virgin Money, Metro and Secure Trust. I've got their asset position, their liabilities and their equity, and I've taken the market value from Google Finance, and I've calculated the price to book value based on their market cap and equity. So what I've done is I've taken the market value there, divided it by the equity to get my price to book value. So that means for every 47 pence you put in, there's £1 worth of asset behind it, which is where you get this price to book from. So all of them actually look kind of similar. They're all in that same sort of range. The biggest outlier here is Metro Bank, which has a price to book value of 0.13. So this is really significant, because what that means is for every 13 pence that you put in, there are £1 worth of assets behind it backing it. That's actually a very interesting price to book value, actually really low when you look at the market. There's probably a good reason for it. Definitely one that's worth some time and some analysis. So I'll probably look at that in a little bit of detail. So with any annual report, it's always very important to remember that this is a snapshot. It's a point in time snapshot of a company. What you see there isn't necessarily representative of what you're currently seeing in the share price, because there are things that happen between the point in time when the annual accounts are published and the statements are produced to the current time when you're looking at the share. So always be mindful of this. So this method is very good when you're looking at the market cap of a company, and you're also then trying to look at what the company it actually holds assets wise. It allows you to see the difference between what the company is worth if you were to dilute it fully, and what the market is valuing the company at any given point in time. So the difference there can help you identify whether it's a good or a bad idea to invest. I hope you found the video useful. If you did, please remember to like and subscribe. It helps me out a lot. And also check out the channel. There are a few other videos on there, and I'll be doing some more on different topics as we go through.